Okay, so we're looking at the uses and limitations of the income statement. Basically, the income statement is used to evaluate a company in terms of, is it going to be able to keep generating cash flows in the future? So it's a pretty important in terms of trying to predict how a company is going to do in terms of future profitability. You don't ignore debt on the balance sheet, and you don't ignore the statement of cash flows, but income statement, good place to start. When we're looking at the limitations of the statement, there's a lot of information that obviously can't be included, and the income amount is going to be affected by the various accounting methods used, so there may be some lack of comparability. And estimates and judgment are part of the income statement as they are of the other financial statements. And that brings us to sort of the quality of earnings and earnings management. Earnings management is defined as the planned timing of revenues, expenses, gains, and losses to achieve earnings targets or to smooth earnings. These activities are not according to GAAP. You think about the income statement, it is supposed to record what actually happened, what revenues actually came in this period, what expenses were paid, not using accounting techniques to plan the timing of revenues, expenses, and things. So basically, earnings management, it's manipulating the accounting data to achieve some desired results, and it happens all the time. So you can, maybe management wants to decrease current earnings, so they can, have a little slush fund available for future performance numbers, or maybe they need to increase current earnings to hit some various targets that they have now. Either way, it's distorting the information, and it makes the quality of earnings less. In other words, it reduces the usefulness of the statement. So examples of smoothing. W.R. Grace was a Florida-based chemical company, and they had a large healthcare subsidiary. And the subsidiary received a huge unexpected payment from Medicare. So rather than book that $50 million as income for the year as properly they should have done, they said, oh no, well that will distort our growth record. It'll make us go like this year, and then next year it'll drop down again, and maybe our stock price will suffer. So what they did was, basically what they should have done is go cash, debit cash, credit revenue for 50,000, or was it 50 million? Sorry, 50 million. What they did was they debited cash, and then they debited a deferred revenue, which is a liability account for the 50 million. So when they needed to recognize some of that revenue, they would simply debit the deferred revenue and credit revenue. It's what's called cookie jar reserves, or a rainy day fund. They take, they just put all that revenue into a liability account, which doesn't make any sense at all, but that's what they do, and then use it as needed. So anyway, the basic principle that you want to be aware of is that revenue should be reported in the period when it was earned or the performance obligation was satisfied. So that's what happened. The Grace used that to smooth their earnings. So when they sold the healthcare division, they released all the excess reserves into income as a change in accounting estimate, which also was not GAAP. So the Securities and Exchange Commission got involved, and the company was charged with misleading investors, and part of they had to do a settlement. Okay, so one thing to keep in mind is sort of a structural framework when we're classifying where to report something on the income statement. So this little chart could come in handy. Let's take a look at it. We've got different sorts of things that are reported, and what the question is, what are the most important in determining the future profitability of the company? Basically, it's going to be the primary business the ongoing operations main line of business. That's going to be the best predictor of how the company's going to do. So we have sort of the primary business. A company might sell off part of its primary business. That would be discontinued operations. These would be non-recurring because it's not there anymore. They've sold it off. So non-recurring items on the income statement would be things like your profits and loss from discontinued operations. These are unpredictable. You know, they don't happen all the time. They're irregular, okay? It might have been predictable, but it's definitely irregular. And then you get the other non-recurring items, which are like your storms, hurricanes, and I always like to put the meteor landing on the warehouse. Anyway, so these are all non-recurring, not particularly predictive of what's going to happen in the future. Your recurring items, the main line of business, and then you've got the peripheral activities. You have your cost of goods sold, all your regular expenses and all of that. Then you've got interest from various investments. You could have dividends from stock investments, gains and losses on the sale of equipment. These are peripheral activities. They're part of your business, but they're not your main line of business. So when we're classifying things on the income statement, management is going to want to put as much of the sort of good news here, because that's going to predict really good positive results. They're going to want to sort of report lesser or bad news somewhere else. They'd rather show it as, you know, non-recurring or, you know, peripheral activities. You know, think of the Exxon Valdez oil spill. Do they want to put that in as part of their main line of business? The BP explosion, or maybe Columbia Gas more recently. Do they want to say, oh yes, that's part of our main operations, or put it somewhere else where it will have less impact on you know, the analysts when they're looking at the financial statements? Okay, so this is just a sort of a good structure to keep in mind as you're working with the income statement. Okay, I think. All right, I think that's it. So next we'll get to the various formats of the income statement.